probably heard some version of this sentence. Renting is throwing your money away. Buying is the smart move, because instead of paying a landlord, you're paying yourself. Every monthly payment builds equity. Every year you own, you get richer. That sounds logical. It's also only partly true. And the part that's missing explains almost everything strange about how real estate actually behaves. Why some homeowners get wealthy and others get wiped out by the exact same market. Why a rising home price can still mean you're losing money. And why the single most common investment in America has, for most of its history, barely beaten inflation. To understand that, you have to stop thinking of a house as one thing. It's actually three things stacked on top of each other, and only one of them builds wealth. The first is the house itself, a physical asset that ages, breaks, and needs constant reinvestment just to stay where it started. The second is the loan you use to buy it, a financial instrument that behaves completely differently from the house it's attached to. And the third is the tax and policy environment around both of them, which quietly subsidizes the whole arrangement in ways most owners never notice. Almost every myth about real estate comes from collapsing these three things into one and calling it the house. Start with the loan, because this is where the story gets interesting fastest. When you take out a 30-year mortgage, your monthly payment doesn't split evenly between interest and principal. Early on, it's almost entirely interest. On a typical 30-year loan, in the first few years, roughly 70 to 80% of each payment goes toward interest, the cost of borrowing the money, and only a small sliver actually reduces what you owe. This is called amortization, and it's structured this way because interest is calculated on the remaining balance, which is highest at the start. The split doesn't flip toward mostly principal until you're roughly halfway through the loan. Here's why that matters. If you sell or refinance in year 5, which a large share of homeowners do, whether from a job change, a divorce, a growing family, or simple restlessness, you've paid years of interest and barely dented the actual debt. The "I'm paying myself instead of a landlord" story only really pays off if you stay long enough for the math to turn in your favor. Leave early, and a meaningful share of what you paid was rent too. It just went to a bank instead of a landlord. So if the mortgage isn't automatically building wealth in the early years, where does homeowner wealth actually come from? This is the part almost nobody explains clearly, and it's the key to the whole system: leverage. Say you buy a $400,000 house with a 10% down payment, $40,000 of your own money, $360,000 borrowed. If the house appreciates 5% in a year, it's now worth $420,000. That's a $20,000 gain. But you only put in $40,000. Measured against your actual investment, that's a 50% return in 1 year. That number has nothing to do with the house being a great asset. It's what leverage does to any return, good or bad. Put down less money relative to the asset, and every percentage move, up or down, gets magnified against your own stake. This is the part that should make you pause. That same leverage cuts exactly as hard in reverse. If the house drops 5% instead, you haven't lost 5% of your money. You've lost 50% of it. The house barely moved. Your equity got wrecked. And this asymmetry, small moves in the asset, huge moves in your actual wealth, is the single most important fact in residential real estate, and it's almost never the headline. Now here's the discovery that surprises most people, including people who've owned homes for decades. Strip away the leverage, and the house itself has historically been a mediocre investment. Economist Robert Shiller, who built one of the most widely cited long-run indexes of U.S. home prices, found something that contradicts almost everything real estate agents and popular wisdom tell you. Looking back over more than a century, from the late 1800s up through the early 1990s, real inflation-adjusted home prices in the United States were remarkably flat over the long run. Not zero, there were booms and busts along the way, but nothing close to the steady climb people imagine when they picture real estate always goes up. That phrase, real estate always goes up, is one of the most repeated and least accurate ideas in personal finance. It's true in nominal dollars because almost everything rises in nominal dollars when a currency loses purchasing power over time. But nominal price growth isn't wealth. If your house is worth twice as much in 20 years, but everything else also costs twice as much, you haven't gotten richer, you've just kept pace. So, if the raw asset isn't a wealth machine on its own, why do so many homeowners end up wealthier than renters? 3 real, well-documented reasons, and none of them require the house itself to be a great investment. The first is leverage, which you already understand. It magnifies whatever the market does, and over long periods where prices at least track inflation, that magnification tends to work in the owner's favor, especially in growing metro areas. The second is forced savings. A mortgage payment is in part a commitment device. Renters who intend to invest the difference between renting and owning often don't actually do it. The money gets absorbed into everyday spending. Homeowners, by contrast, are contractually required to make that principal payment every month, whether they feel like saving or not. Over 30 years, that discipline compounds, even if the underlying asset is only average. The third is the tax and subsidy environment. Government policy, from federal mortgage interest deductions to capital gains exclusions on primary residences, to decades of infrastructure and lending policy favoring single-family homeownership, has tilted the playing field in favor of owning. Homeowner wealth isn't purely a market outcome. Some of it is policy, engineered over generations. Put those three together, leverage, forced discipline, and subsidy, and you get most of the homeownership builds wealth effect. Very little of it comes from the house being an unusually good asset in isolation. Which brings us to the costs nobody puts on the brochure. A widely used rule of thumb among real estate professionals and personal finance analysts is that ongoing maintenance costs roughly 1% to 2% of a home's value every year. For a $400,000 house, that's $4,000 to $8,000 annually, just to keep the place from deteriorating. Add property taxes, which vary by location but commonly run another 1% to 2% per year. Add homeowners insurance, which has risen sharply in many regions due to increasing climate-related risk. None of these payments build equity. They're the cost of holding the asset, similar to the way a stock has trading fees or a business has overhead. Then there's the cost most people only discover when they try to sell: transaction costs. Real estate agent commissions, closing costs, transfer taxes, and moving expenses commonly add up to somewhere around 8% to 10% of a home's value between buying and selling. That means a house has to appreciate by roughly that much just for the owner to break even on the round trip. Compare that to selling a stock, where transaction costs are often close to zero. This is a big part of why real estate rewards people who stay put for a long time and punishes people who move frequently. The fixed costs of entering and exiting the market are enormous. And finally, there's the cost that's invisible because it's what didn't happen: opportunity cost. That $40,000 down payment from earlier wasn't just sitting there. It was money that could have been invested elsewhere. If it had gone into a diversified stock portfolio instead, it would have grown too, without needing a new roof or a plumbing repair. Whether real estate or the stock market wins that particular race depends heavily on the decade, the city, and the specific property. But the comparison itself is almost never made by first-time buyers, who tend to see the house's rising price and nothing else. A rising price with rising costs sitting underneath it is exactly the kind of healthy-looking number that hides a weaker underlying picture. And that gap between what a home appears to be worth and what it's actually costing its owner is precisely the mechanism that, when enough people ignore it at the same time, can turn into a systemic problem. That's exactly what happened in the years leading up to 2008, and it's worth walking through slowly because the chain reaction is the clearest demonstration of how these hidden mechanics actually behave under pressure. In the late 1990s and early 2000s, U.S. home prices began rising faster than incomes, fueled by low interest rates and a rapidly expanding mortgage lending industry. Lenders, competing for volume and often selling the loans off to be bundled into securities rather than holding them, began approving mortgages for buyers who previously wouldn't have qualified, loans requiring little or no documentation of income, and loans with low initial teaser rates that would reset higher after a few years. Because prices were rising, this didn't feel risky. If a borrower ran into trouble, conventional wisdom said they could simply refinance or sell into a rising market. That assumption was the first domino, and it was resting on a belief we already dismantled, that home prices reliably go up. As long as everyone believed it, the system reinforced itself. Rising prices justified looser lending. Looser lending pulled in more buyers. More buyers pushed prices higher still. National home prices, by some measures, nearly doubled between the mid-1990s and their 2006 peak. The first warning sign came quietly. In 2006 and into 2007, price growth in many markets slowed, then started to reverse in some regions. For homeowners who had bought recently with little money down, this mattered enormously. Remember the leverage math from earlier. A relatively small decline in home value can wipe out a highly leveraged buyer's equity entirely. Borrowers who owed more than their homes were worth, a situation known as being underwater, began defaulting in large numbers, especially those holding adjustable-rate loans, whose payments were now resetting higher at the worst possible moment. Here is where the chain reaction accelerated. Those defaults weren't isolated events. Because so many mortgages had been bundled into mortgage-backed securities and sold to investors worldwide, losses on individual homes translated into losses across the global financial system. Financial institutions holding these securities faced enormous write-downs. Some, like Lehman Brothers, collapsed entirely in 2008. Credit tightened sharply as banks, suddenly cautious, pulled back on lending across the entire economy, not just mortgages. That credit freeze deepened the recession, which caused unemployment to rise, which caused more mortgage defaults, which pushed prices down further. One failure did not remain one failure. It spread sector by sector until it became one of the deepest global recessions since the Great Depression. By the time home prices bottomed out around 2012, U.S. home values had, in aggregate, fallen roughly a third from their peak. Millions of American families lost homes to foreclosure. And crucially, this is the detail that connects everything back to the beginning. The families hit hardest weren't necessarily the ones who bought the most expensive houses. They were disproportionately the ones who bought with the least equity cushion, the highest leverage, and the thinnest margin for error. The mechanics we walked through earlier, leverage cutting both ways, transaction costs punishing short holding periods, the gap between price and true cost, weren't abstract concepts during the crisis. They were the specific reasons some households lost everything, while others, who'd bought more conservatively or simply held on, eventually recovered. The system that emerged afterward looked different. Lending standards tightened substantially. The era of no documentation loans and minimal down payments for average buyers effectively ended, replaced by stricter income verification and, for most conventional loans, larger down payment expectations. At the same time, a new kind of buyer entered the market: large institutional investors who began purchasing distressed single-family homes at depressed prices and converting them into rental portfolios, a business model that barely existed at scale before the crash and has only grown since. The individual, leveraged, thinly capitalized homeowner from the 2000s was, in some corners of the market, replaced by well-capitalized institutions playing the exact same leverage game with far more cushion to absorb losses. So where does that leave the person watching this video and wondering whether to buy? In the best-case scenario, buying a home in a growing area, holding it for a decade or more, keeping leverage manageable, and maintaining the property properly delivers exactly what the popular story promises: forced savings, leverage depreciation, tax advantages, and eventually a paid-off asset that provides housing cost stability in retirement. That outcome is real, and it happens to a lot of people. In the realistic, more typical scenario, a homeowner builds wealth more slowly than the sale price suggests because maintenance, taxes, insurance, and transaction costs quietly consume a large share of the paper gain, and the true return, after all of that, often lands closer to modest than spectacular. In the realistic negative scenario, someone buys at a market peak with minimal equity, faces a job loss or rate shock, and discovers that leverage, the same force that would have made them rich in a rising market, instead erases their entire down payment and more, exactly as it did for millions of households between 2007 and 2012. None of these outcomes depend on whether real estate is a good investment in the abstract. They depend on leverage, timing, holding period, and a buyer's capacity to absorb costs that don't show up in the sale listing. So go back to that opening idea. Rent is throwing money away, buying builds wealth automatically. It isn't false exactly, it's incomplete in a way that matters. A house isn't a wealth machine because bricks or land are magically valuable. It's a leveraged, forced savings contract, subsidized by policy, wrapped around a place to live. And every dollar of wealth it produces or destroys traces back to how that leverage, that discipline, and those hidden costs actually play out over time. Understand that, and home ownership stops looking like a guarantee. It starts looking like what it's always actually been: a financial instrument that rewards patience and punishes overreach, dressed up as a home.